Welcome to the Do More podcast, where we share strategies and tips for improving your life in every aspect. Here's your host, John Farling.
All right, welcome back to the show. Today we've got another fellow self-storage investor, Baird Kleinsmith, and I'm eager to learn more about him. I'll be honest, I don't know a ton. I know he's in self-storage, know a little bit about him, but have him on the show to learn more. And I know he's doing some other things kind of in the space, not just buying storage facilities. So interested in learning about those. Baird, welcome on the show. Why don't you tell us a little bit about yourself?
Yeah, thanks, John. Good to be here. Thanks for having me. Let's see, my story as briefly as I can make it. So I spent 16 years in financial technology, living the corporate life. That was a great journey. I got a bunch from it. Made a bunch of friends, had some great experiences. As part of that, I moved to London in the United Kingdom for 3.5 years. And left my job there at the beginning of 2020, right before the pandemic hit. We actually sheltered in Scotland. We moved out of London, sheltered on a 2,000-acre estate on the ocean in southwest Scotland. And I didn't have a job. We were holed up on this estate, and I started thinking about what was next. I knew I was moving back to the States in August at the end of the summer, and I got really interested in acquisition entrepreneurship. I read the Harvard Business Review book about buying businesses. I started listening to podcasts. But as I was thinking about the reality of like buying and operating a service business, it didn't excite me. Like I wasn't interested in running a plumbing business. So I got back I live in Durango, Colorado. We came back here in August of 2020. And I just had no idea what I wanted to do with my life. I didn't want to go back into the corporate world. And at the end of, I think it was at the end of middle of November of 2020, I heard Nick Huber on the My First Million podcast. And he described his strategy of buying mom and pop mismanaged storage facilities, primarily in the Northeast and Southeast, implementing technology, managing revenue, managing expenses. And I was listening to this podcast on a mountain bike ride. And I remember it clicked. I was like, oh, that sounds like something I could do. It doesn't sound operationally complex. I've learned a lot more about that. It's not exactly passive. But it excited me. It was like the first thing that I really got excited about. So the next day I Googled all the storage facilities within like a 60-mile radius of where I live in Southwest Colorado, went manually one by one into the county assessor database and pulled the owner information. Typed up a letter, and I think I sent a letter to about 50 or 60 storage facility owners in Southwest Colorado and Northwest New Mexico. And then I just sat and waited. And I know my results were not typical in that I ended up buying 4 storage facilities within the next 12 months from that one group of letters. So I got my first call back shortly after I sent the letters. From the first facility that I ended up buying. It was in Northwest New Mexico. I ran the numbers best I could, and in a model that I built, I reached out to guys like Nick Huber and some others that had some experience and got a little bit of help in underwriting. I actually paid Nick for his consulting call. We walked through the numbers on that deal, and he said, yeah, this is going to make you $1 million in the next 18 months. Fast forward to today, I've bought 10 facilities for a total purchase price of $21.5 million. I now own 9. I sold that first facility that I bought back in February of 2021, and I did a reverse 1031 exchange into the purchase of a $12 million property, 115,000 square foot, $12 million property that I bought on Halloween of last year. So today I'm sitting with 9 facilities. Anywhere from small ones at about 10,000 square feet up to this big one with 115,000 square feet. And I'm loving it. I never thought I would find a career that was so strangely satisfying. But there's something about storage, buying something that's mismanaged and fixing it up, seeing the results of that work. I love it.
That's awesome. And it's funny. And I want to touch on I guess leaving the corporate world and going off on your own. But it's funny because you said not many people, you sent out 50, 60 marketing letters and got, would you say 4 deals out of it?
Yeah,
Not many people do that. What's insane is I literally have those exact numbers and say the same thing. So it's wild that we have the same, like I literally sent out 50 or 60 and I got technically 4 deals out of that campaign, which is, it is unheard of, but it's funny that we have like, it's cool to have that connection.
I just feel like I always have to, I always have to give the disclaimer that like that hit rate is not common because I know many people who have sent thousands of letters and gotten nothing. So I think it was my success was a combination of good timing, some luck, and then also just taking action. Like, like I like the name of your podcast, the Do More Podcast. Like I could have overthought all of that. I could have, done a bunch more research, made sure that this was actually an asset class I wanted to go into, but instead I just decided to go. I sent the letters and I think that sort of created some momentum of movement there.
Yeah, that's awesome. And I want to get into that. But first I want to know, so you were working a W-2 job and obviously COVID hit and things changed, but what made you think, okay, I'm just going to go out on my own? You said you looked at service businesses, which is funny because I've been looking at those and still haven't pulled the trigger. What made you think like, I'm just going to go out on my own as opposed to finding another W-2?
Yeah. I was always on this, like the FIRE track, financial independence, retire early. And I had this, I had the 4% rule. And I thought, if I could make, what's the number I need to get to X millions of dollars in the bank where I can live on, 3 or 4% of that. And to be honest, I moved to London for an opportunity that I thought I would be coming back home with enough money to retire, and that didn't pan out. The pandemic threw that off. I'm still waiting on the exit there. I didn't have enough to retire, and so that made me think, well, I don't have enough to retire. I'm not sure I actually want to retire, but I don't want to go work for somebody else. And so I was searching for something to buy, and I didn't want to go back into the W-2 because I wanted control of my time. Like I just had worked 16 years, dedicating my time to building primarily, building wealth for myself, but generating much more wealth for the shareholders of the businesses that I worked for. And I just thought, I want something where all of this work is going towards building wealth for me, while more importantly, freeing up my time so I can spend it with my family, traveling, doing whatever I want. And it's actually when I sit here and I think about where I was then, I was actually in this spot of desperation of sorts. Like, I had the W-2 to fall back on. I knew I could go get another job. And the longer version of the story is I actually ended up getting 2 more jobs and quitting them while in this process of building the storage portfolio, because that W-2 bi-weekly, bi-monthly pay it's nice. It's hard to wean yourself from that, especially when you're in the early phases of building a cash flowing portfolio. But luckily I quit both of those so that I could focus on storage. And now I have, almost complete freedom of time, get to travel a bunch, spend as much time with my family as I want.
That's awesome. That's awesome. Well, and it sounds like, you said it, like you just take action, right? And it sounds like you're probably, we're all afraid of risk, right? Like but there's calculated risk. And it sounds like you're okay with taking on some risk. Like I'm sure you do too. Talk to people wanting to get in the real estate or some type of vehicle that creates financial freedom, but they're so used to seeing everyone around them having a W-2 that they almost don't know any different. And they see like yourself or, someone like yourself, and they're like, well, that's a one-off. He's super smart. I can't do it like him. Why do you think, and it sounds like you put yourself in a situation where you had to make, a risk, but why do you think you have that type of thinking and can take risk on?
Yeah. What's funny is that I've always been very financially risk averse. And I think that goes back to like early childhood. My dad lost everything when I was 3 years old. He was in commercial real estate, was a successful broker, saw the big bucks that the developers were making. He had a massive failed development in Denver when the oil market crashed and the office market crashed in the early '80s, late '80s, and that all, he lost all of his money, he lost his family, and that always sat in my head. It's like I don't ever want to lose it all. And so forever I was very financially risk averse. Like, I can't even, I never want to calculate how much I've missed out on by keeping, money as cash rather than in equities over the, 20 plus year period I could have been investing. But something changed then. And it was, I think you said it, like I had to make a change. I was lucky in that I had capital to deploy, and my focus at that point became, what's an avenue for me to maximize the cash on cash returns of the capital that I accumulated. And I knew that I had to take risks in order to capture outsized gains. But every deal I do, I've made sure that there was a very good margin of safety. Like all of my deals are extreme value add deals. And I'm often paying, above market prices, like very low cap rates. I'm jealous of all you guys that are buying deals at 8 caps and then turning them into 12 caps. I'm typically buying deals at 4 to 6 caps and turning them into 12 caps. But I just I've focused on sort of mitigating the downside risk by generally buying things below replacement cost and having just a really clear path to that value add. And even if cap rates fluctuate, I'm not depending on an exit to generate returns. I'm primarily focused on generating cash on cash returns. And that's a benefit, I think, I've only used my own money. I don't raise investor capital. So I have full control, and I don't have like the pressure of investors to exit to generate an IRR.
That's I kind of want to talk about that before we keep going with your story, but it sounds like we invest similarly, and obviously we're a little biased, but I want to hear your thoughts. I've been thinking about this lately, especially I joined a group where there's a lot of syndicators, and I use my own money. My main metric is cash on cash return. I don't even look at cap rates. Will I kind of look at it, what my exit will be? Yeah, I'll look at it, but I don't care. I don't, like you said, you buy it 4 caps and you're at a 12 cap, like in a year after you own it. Like that's basically what I'm doing too. I've probably paid less than 4 caps, but I know day one I've got a heavy value add. So I've been thinking about this. All these syndicators are buying these deals 100% financed, right?
Yep.
And the money they're syndicating or raising is super expensive money. I think that's crazy risky. What are your thoughts around that?
Yeah. So I've been faced with this decision multiple times over the last 3 years of doing this. I've had a lot of people ask me, like, why don't you go raise capital and make this really big? Like, why settle with 9 or 10 when you could go and do this across hundreds and make, an incredible amount of income on just the fees that you charge investors. And I just think about the life that I want to live. And I want to live an independent life of freedom. And I don't want to have to report to anybody except maybe the banks that have lent me money. And so I think, maybe I could create probably a lot more wealth if I went down the path as a syndicator. But I'm kind of at a point now where I've got enough money to do the things that I want to do. And I don't need more. Like, I'm actually in this like great spot now where like the cash flow off these properties finances the lifestyle I want to live. And I just I don't need more than that. I love more than that, but I'm not willing to sacrifice the freedom to get there. But I also recognize that I'm in a fairly unique position of having enough capital myself to do this, and not everybody's in that position. Some people starting out just don't have that level of capital that they need, and have to go to outside investors. But I guess to answer the question, I've thought about the reality of building a private equity business versus a lifestyle business, and I always come back to the lifestyle business is the life I want to lead.
Yep. No, I'm with you. It's kind of what I've settled. It's hard too, especially when I've got a lot of syndicators around me, and obviously, most of them are doing really well, but it's good talking to people like you, because it reassures you too, right? Because I would say majority of investors I'm around, and I don't know what the percentage is, whether it's 60% or 90, I don't know, but most of them raise money some way. So it's nice to find another investor that uses your own cash to get in deals, because to me it's more rare. We can only go so far. I get that, but like you said, it's a lifestyle thing too.
Yeah.
So that first deal of yours, obviously you found 4 deals from your first mailing campaign. What did that deal look like? Obviously, we somewhat know how you funded it, but tell us about bank financing and tell us about any challenges you had with that, because obviously it's your first deal, so you're kind of going in blind.
Yeah, I was I got lucky in many ways, but so this was a 26,500 square foot facility. Bought it for 1.1 million. I'm not good at public math, so I won't do any calculations on the fly. But I remember I bought it for 1.1 million at a 7.5% cap rate. And this was in February of 2021, when things were really hot. And it was like buying something at a 7.5 cap that felt like a win, not knowing anything. But the property was 100% full. It had an on-site manager. I had a website, but no online rentals. They were using old SiteBank software. The manager was grumpy, and it was only she was actually on site, but because of the pandemic, she had moved to remote. She was working from home. Was pretty expensive. So I looked at the financials, and not knowing anything about storage, I could just see places where, one, they weren't maximizing revenue. They were 100% full at lower rates than many of the competitors in the market. And I just saw there was some really fat expenses that could have been trimmed. Like they were paying $750 a month to a bookkeeper. Not knowing anything at that time, I thought, a bookkeeper can't cost $750. I bet I could do that myself. They were paying, they had a fax line that they were paying for. They were paying $250 a month for their phone bill that was unnecessary. So I saw all that plus the revenue gains opportunity, and just ran the numbers and figured that I could double the net income, and which I did. So bought it for 1.1 million. I don't know all of the numbers, but ended up selling it in December of last year at an 8.5 cap. So I sold it at a high cap rate, but still sold it for $2 million. So I had a $900,000 gain. And in the process, so going back to the original question, like around financing, I got really lucky with introductions to people. A good friend of mine introduced me to a real estate attorney locally, who turns out to be amazing. And he's just an incredible attorney. That attorney he was on the board of a local bank here. And so when I started looking for financing for that deal, he introduced me to the head of commercial lending at that bank. And I was able to sort of pitch them that while I had not had any experience to that point in running a storage facility, I had enough sort of business acumen and experience managing profit and losses for large companies that storage should be pretty easy. And I built like a very detailed business plan. I think that's like the last business plan I've ever done. But I built a very detailed business plan, sort of had a very clear vision for how to achieve that increased value and cash flow. And luckily the bank took it. So I brought 25% down on that one. So I think it was about 275,000 I brought down, and then I borrowed about 850,000 from the bank. At that time, I think it was at 4%, 7-year term. So it was pretty nice. But I had later on, when I was buying my 6th property, I think it was my 5th, it was my 6th property. I went to another local bank here with that one, and they said, well, we'll give you a really good deal for all of your portfolio, but you have to refinance those 2 properties that you have with that other bank. You have to refinance those with us. And so I ended up doing a cash out refi on that, pulled like 350,000 out. And so I got my full down payment back. And then I needed to sell something to buy this $12 million property, and decided to, sell it. And then I ended up selling it for $2 million. And then I ended up selling it for $2 million. And then I ended up selling it for $2 million. And then I ended up selling it for $2 million. And then I ended up selling it for $2 million. And then I ended up selling it for $2 million. And then I ended up selling it for $2 million. And then I ended up selling it for $2 million. And then I ended up selling it for $2 million. And then I ended up selling it for $2 million. And then I ended up selling it for $2 million. And then I ended up selling it for $2 million. And then I ended up selling it for $2 million. And then I ended up selling it for $2 million. And then I ended up selling it for $2 million. And then I ended up selling it for $2 million. And then I ended up selling it for $2 million. And then I ended up selling it for $2 million. And then I ended up selling it for $2 million. And then I ended up selling it for $2 million. And then I ended up selling it for $2 million. And then I ended up selling it for $2 million. And then I ended up I decided to sell that one, capture the gain there. I'd gotten most of the upside, and then was able to protect the gains there via 1031 exchange and just roll it straight into that next one.
That's awesome. So you said you have 9 now. How did that process look like? Did you do any more cash out refis, or did you just have enough money, ammunition, and chambers where you could just keep buying these with traditional bank financing?
Yeah, so that was my only cash out refi. I had enough capital that I could get those. When I first started this, I thought, okay, I'm going to put 500,000 of my money in, see how it goes. I got there, and it was going well enough that I decided to continue to tap into the capital that I had. Most of my deals I've gone in very highly levered. I've done a bunch of SBA 7A deals where I'm only bringing 10, 15%. I've done how many 3 seller carry deals. Some of those, one of them was I had to bring 20%. The others I've only brought like 10, 15%, and borrowed the rest from the seller. So I've been able to sort of generate a lot of scale just by going in highly leveraged, which it sounds highly risky, but I just knew that I had such a clear path to value add on these, where I'm going in at 10, at 90% levered, but very quickly, getting down to 60, 50 or 60% levered with the value add, even with expanding cap rates.
Yeah. No, it's not. It's funny because it sounds like I'm listening to someone else kind of tell my story, because I've done same thing. SBA loans, 10%, some 15% down, some seller financing, same thing. Trying to get the most out of the capital that I've got without using other people's, private money.
Yeah, and I think the other point too is that I've always lived really lean. Like I've lived well below my my means, and especially when I was building this storage portfolio, I just really focused on reinvesting as much of the cash flow back into additional purchases. So I think by the time I bought my 7th or 8th property, actually, it was my 7th property, that acquisition was financed purely from the cash flows of the 6 properties that I had bought.
That's awesome.
Before. Because we just continued to live. We live well, but we are very cost conscious. I'd say only recently have we actually decided to start spending money, because we sort of achieved that income level where we're good.
Yeah. Well, and that's a hard thing to do. I don't think enough people talk about that. Is stay, just because you're making more money doesn't mean you need to go spend that more money, right? Like you should reinvest that. And if you're comparing this to like you talk about service business, if you compared this to a service business, you probably wouldn't be taking money out right away. You'd be plugging it right back into the business, possibly for a few years, which is basically what you did, which obviously paid off. You're in Colorado, right?
Yeah. Yep. I'm in Durango, Colorado.
Where are all your facilities located? Are they nearby?
So I've got one right here in Durango. That was the one that I most recently acquired. And then I have, let's see. So of the 9, 7 are in Colorado, all in Southern Colorado. But as far as, I've got some that are as close as, well, just down the street, and then 30 minutes away, a group of 3 that are about an hour away. And then 3 hours continuing that direction, another that's like 5.5 hours away, also in Colorado. And then I have 2 in southern New Mexico that are a 6.5 hour drive away from me. But I haven't, outside of the one here in Durango, I haven't been on site to any of my properties, in at least a year. I drive by them all the time, but rarely actually go on site. I've got a great team that manages everything now.
Nice. So what's your, I don't know. Well, one, what challenges have you faced operationally? Because obviously there's challenges, finding deals, closing, funding, all those things. Operational wise, what challenges have you faced?
Yeah. It took me a while to figure out how to manage these things. The remote management model was such a black box forever. Like I had heard of people that were managing properties remotely, but I just didn't know how to do it. I didn't know what the details were of how to do that. And I went through a few iterations of that. The first property I had the on-site manager. I kept her on for a little while, and then let her go, and I self-managed for a bit. So I answered the phones, but found a good, reliable, boots on the ground person to do all the on-site stuff. And so for a little while, I was hiring local boots on the ground, the local contractors to do all the on-site stuff, and then I was the guy answering the phones. Pretty quickly realized I didn't want to do that. I didn't want to spend my time, renting storage units and chasing payments. So I actually hired my sister-in-law to take over on that. And then I pretty quickly realized that it was pretty below her skill set, and she was pretty expensive too. And I had heard about people that were hiring, offshore or near shore. And so I first started trying to hire in the Philippines. I actually hired 2 folks in the Philippines and went through both of them. I was asking them to work, daylight hours here. It was overnight for them. They were sleepy and sleeping on the job. And I had heard of others that had success hiring in Latin America because of the similarity of time zones. So fast forward to today, my entire remote customer service team is in Latin America. I have an ops manager who actually functions more like a general manager now. She's based in Venezuela. She runs everything. So she runs the customer service team. She manages all of our vendors. She does all of our marketing. She manages our boots on the ground. And then we've got 3 customer service agents in Peru and Venezuela today as well. And it runs really smooth. And then we've got great site managers at each of the properties. The big $12 million deal is the only one that has a full-time site manager. We actually have an apartment at that property. Found a great guy that lives on site in that apartment and works full time. I mean, it's a big enough, complex enough property that it requires somebody full time working on site stuff.
Sure. So your other sites, smaller sites, are they more part-time guys that are like boots on the ground?
Yep. Yeah. So most of the others, I mean, even including my second largest property is 40,000 square feet. All of them are part-time contractors. I found that the right profile for that is somebody who's retired or semi-retired, has a handy background, has experience fixing things, and somebody who's just looking for a reason to get out of the house and put their effort into something. So we've been lucky to find a really good group of guys that fit that profile.
Sure. Have you over the past? Well, I'll let you tell me the time frame. Have you seen a drop off in occupancy, and if so, when and how's that looked?
Yeah, things have definitely softened. I'd say it started last fall, probably like August, September timeframe. We started to see things get pretty quiet. But I think the most recent one is not a good example because it was just a mess that we took over. And I mean, we're going to have one day of auctioning 53 units. Like, we've got another 20 plus units that are just full of junk that we can't track down the customers, and so we're disposing of those items. So that one's at like 75% occupancy. I bought it at 90. It's now at 75 because of all the cleanup. But among all of the others, like the other 8 that I own today, we're anywhere. I think the lowest occupancy we've got is maybe 85%, and some of them are up, north of 98% occupied. So, but then I've got a group that are in a smaller town where it's just gotten really quiet in that town. Some of it's seasonality, but I do think that there's, I think that the softening of the economy, people buying less, people moving less, is certainly impacting things. But I've been pretty lucky to stay north of 85% occupancy on all of them. But some of those that are 85%, they were 100% occupied, a year ago. So definitely seen some shift there.
Yeah. No, I'm seeing the same stuff and similar numbers too. And we're somewhat set up very similar. I'm in, I think, 6 different markets, and very thankful that I'm not just in one market, or I just don't have 1, 2, or 3 facilities, because I'm there's one market that's super soft, and then I've got probably 2 or 3 that are so strong, and it doesn't like. I don't know if there's just more hoarders in the area. I have no idea because they're going through the same economic things everyone else is, right?
Yeah.
I'm in, I guess, kind of the one town where I'm seeing softening. There's probably more white collar jobs, so the median income is a little bit higher, but so there's probably less moving there. But otherwise, like the markets that I'm seeing strong rental demand, the median income is a little bit lower. How are you seeing things in comparison to your markets?
I've always been surprised by that. My best performing facilities are in the least attractive economies. Like the one that I sold was, I mean, there was like 25 square feet per capita, which is just crazy amount of storage inventory. It was on the edge of the Navajo reservation, so a lot of I had to move a lot of people off of cash and check payments, but man, that one always stayed like near 100% occupied up until the day I sold it. And I'd say my best performing facilities today are in markets where you look at the demographics on paper and they don't look good, but for some reason there's demand for storage in those markets. I don't understand it. No. It's I'm not smart enough to know like what's driving that. But when I'm buying, I'm typically trying to buy in markets that are near full occupancy, and without any new development in the pipeline. Because I think that's the thing that really scares me is somebody comes in and builds 50,000 square feet of storage. And it throws off the supply demand in that market.
Yep. So what are your metrics when you're looking to buy a facility?
Yeah. So I'm, as I mentioned earlier, I'm primarily focused on cash return. I also have targets for debt service coverage ratios, not just to meet bank covenants, but just for my own personal risk tolerance. Like I'm trying to get up to at least like 1.5 to 2x debt service coverage. Yep. And then I think it sounds very similar to you. Like I kind of run some scenarios of, exit cap rates and hold periods to come up with some idea of how IRR would look over certain timeframes. But I'd say that's more for entertainment. It's more interesting than is it a decision-making factor. But I'm primarily looking at the cash on cash return. I want to get the greatest return on the capital that I'm deploying.
All right. You brought up square foot per capita, and I think most people listening know what that is. But if they don't, that's basically all of us are. Well, I'll let you. You can explain that ratio if you want.
Yeah. So square foot per capita. If you took all of the the storage square footage in a market, and then you divided that by the total population within certain radiuses of that market. So you'll see it within 3 miles, 5 miles, 10 miles. You end up with a square foot per person within that area. And I think some operators use that as a metric to identify like sort of the supply and demand balance in a market. But I find that it's not helpful. And I'm more focused on what's the occupancy of the current facilities and what are the prices that they're charging. Yep. And that gives me a better idea of the supply demand sort of mix in a market.
No, it's a good point, because actually I was just texting a friend yesterday. He asked, so there's someone building in a town that he's looking to buy, and I don't remember numbers, but it's going to be the square foot per capita obviously is going up. Mm-hmm. I'm like, who cares? You said you've got one with 25. I think I've got one that's over 30, and it's one of my best markets that I'm in. And it's just one of those things that, like what you said, you can't explain, but you've got to look at the market. You cannot look at square foot per capita. It sounds like we invest very similarly, which is kind of funny. Because it's not like, I know I went through a little bit of training with Storage Rebellion, but like I've figured out what works for me, and I'm guessing you've probably done the same thing. I'll look at square foot per capita, but it's like I'm probably close to closing by the time I look at that. And it's I know the market's full, so I don't care.
Yeah.
When did you realize that that was not a metric for you to look at? Because it is talked about a lot.
Yeah. I think early on, those first few deals, I don't think I ever even calculated it.
Oh, really?
And I actually, yeah. So it's really from the beginning. I've never been focused on it. It's always been sort of, it's never been something that I've focused on, to be honest.
Yeah.
I think the biggest thing is just how full is everybody. If everybody's full, then that suggests that there's either an imbalance, there's not enough supply, or it's at perfect balance, which is unlikely.
Yep, for sure. So what are you doing to stay competitive, to continue to drive rates? Are you trying to stay ahead of the game there, or is it just something where it just is what it is, and you're okay with the cash flow that's coming in?
We invest a lot in marketing, not necessarily financially, but like with a lot of effort. So we put a ton of focus into building out our Google profiles. My team is highly incented to gather reviews from customers, and we've got a great process where anytime we have a positive call with a customer, they're texted a link to leave a review. And then I pay the team bonuses for any 4 or 5 star reviews. So it creates a lot of incentive for them. And then just, doing the basic things of having high quality photos, doing regular updates, running promotions. I think we've got a pretty good idea of what Google likes, and we've done well to end up near the top of search rankings. And we do a little bit of paid search. We're on Sparefoot. Some of those things help as well. But I think just really making sure that if somebody's searching for storage in an area that we're showing up near the top of results. I think I need to work a bit more on. I haven't quite figured out the revenue management thing, like at what occupancy should I be raising rents. I think I've been less aggressive than some when it comes to existing customer rate increases. But I also I'm not trying to just squeeze every dime out of my customers. I'm pretty conscious of when was the last time they had an increase, how many increases have they had over time, and try to find a middle ground there of making sure that people are paying fair rates, but not getting overly squeezed.
Yep. No, I'm with you. What size towns are you in, population wise?
Oh, it varies so much. Like 20,000 people here in Durango, down to, I've got a few others that are in similar sized towns. But then, I've got, one of my best performing facilities is in a town of 3,000 or 4,000 people.
Really?
Yeah. And it's the only storage facility in town. I kind of have, I have I have that market until somebody builds something new. I've got that market pretty well cornered.
Yeah. Yeah. Well, and you've made a fair point about the, not raising rates, not going crazy with them, especially with existing customers, especially in the size of the towns that you're in, especially 3,000 population. Everyone knows everybody. Worst case, they know everybody within one person. So all it would take is you going crazy with existing rates, and you're the only one in town, so you could do that. But eventually someone's going to get mad, whether they're like, you know what, forget him. I'm going to drive 10 miles the other way, by another facility, or someone's going to be like, you know what, it's not worth it. And then it's going to be a little bit harder. You're paying more each time you acquire a customer, right?
Yeah.
So I'm with you, especially these smaller towns, and I'm in, we'll call it under 75,000 people or less. Word gets out if you're just trying to squeeze every dime from those people.
Yep. Yeah, absolutely. And I've also that one that's in a smaller town. That one wasn't even, we didn't have to raise rent dramatically to hit targets on that one. We just had to collect what was due. And I've had multiple of those examples where, if we could just collect on the current rent roll, it hit the targets. It's amazing. It's amazing what requiring customers to pay will do. It's amazing that many of the legacy storage facility owners don't use the power of the state laws that were created for their benefit. And so that's this last one, the $12 million purchase. We doubled revenue in 30 days. We took
That's crazy.
from 50,000 a month to this last month, so that we bought it at the end of October. The old owner had been doing 50,000 a month in revenue pretty consistently. Our first month we collected 65, which was a partial month of billing because we were moving people to first of the month billing. And this last month in January we did 106, and we'll get to 100 and 125 probably by May, and I think eventually it'll get up to 140, and that's without that will require some rent increases, but getting to where we are today, going from 50 to 106, was purely requiring existing customers to pay their bills. The prior manager never sent a bill reminder, never locked anybody out, never auctioned a unit, and strangely, he was collecting less than half the rent roll. So
that's crazy.
Part of why I love storage is it's just, parts of it are just really easy. Like you just do things right, and and you win.
Yeah. Well, it's crazy because people say there are no deals out there, and you just bought that end of last year.
At a 2.9% cap rate. Like most people would be like, you bought 600 grand a year in revenue for $12 million. But I knew that if I just, did simple stuff, it'll be worth 18 in less than 2 years, in a really attractive market.
Was that listed or off market?
Off market. So direct outreach to the owner. And I ended up being the perfect buyer for him. He built it from scratch, starting 15 years ago, built it out in phases, ended up with, it's a beautiful 115,000 square foot property, all built within the last 15 years, mix of climate control and non-climate. It's the only climate control in the market. It's a Class A facility, and he had many institutional buyers pursuing him, but he didn't want to sell to some faceless out of town private equity firm. He really wanted to sell to somebody who was local, and I ended up being the perfect buyer for him. And I would be very curious how an institutional operator would have handled the mess that we're dealing with, but it's good.
Yeah. Well, and that's, you knew what the seller wanted, right? And a lot of times I don't think people know what the seller really wants. And I've bought most of mine the same way, where, I mean, there's few of them that, if someone came along, institutional buyer, like they didn't care, they just want to cash out and get as much money as they could. But majority of them are the same thing. They bought it, they built it building by building, and they didn't want to see some institutional come in, because smaller town, just different type of thinking. So yeah, you've got to know your audience.
Yeah. I think the other important thing to call out is that I recognize that every deal I do becomes a reference for me in the future.
Yeah.
And so, now I can tell a potential seller that I've bought 10 facilities. I own 9 of them. I've sold 1 of them. I will give you the contact information for every single person that I bought a property from, and they can tell you how I was to work with. And I've got a great reputation. Like, you talk to any one of them and they will tell you that I did what I said I would do. I didn't retrade deals. I closed as I said I would. And so I think that's really powerful. And that actually, this morning before we got on the phone, I talked to an owner of a storage facility in a market that I really like, who was introduced to me by my attorney. This storage owner has an offer from a private equity group. He somehow ended up having my attorney review the purchase agreement. My attorney reviewed the purchase agreement, and he's like, "Hey, these guys are, there's a lot of, they're kind of pushing you around in this agreement. Do you want? I know a guy who's bought 10 of these. He's local. Do you want to have him look at this and make sure you're getting a fair deal?" And that it turns out the seller would way rather sell to somebody local, versus a big private equity group. And I chatted with him this morning, and we're going to talk. I'm going to look at the numbers, and just what I've heard initially, it sounds like it could be a win-win.
Yep. You make such a great point. And it's funny how I keep bringing it up, but how similar we invest. And this is the first time we've ever talked.
I know.
It's really
it turns out we're soulmates.
I know it. I'm investing soulmates. It's funny because I hear so many people like all the time talk about, well, there's like they get under contract and then they have an inspection. They're like, well, there's $5,000 worth of stuff here I need to fix, 20,000 with the roof, blah, blah, blah. I'm like, don't like you're talking $30,000 on a $5 million project. Who cares? Even if it's 500,000, who cares? Like it's good. It's going to be worth double in 2 months. Why are you worried about that?
Yeah.
I think it's
as long as the upside is there.
Yeah. As long as the upside's there. But you make such a great point of making it easy for the sellers and not retrading, not trying to ding them on the price. I do the same thing. I'm curious to how you do it, but if they have a price that they have in mind, give it to me and I'll see if I can hit it. Yep. If I can, I'm not going to beat you down. Like I'm not going to be like, oh, I'll do it for 20,000 less. How's your kind of negotiation around that?
Sounds very similar. I always try to get the seller to give the number first. And of course there are scenarios where they force me to show my hand first, but I'm usually pretty conservative with an offer if they're forcing me to be the first one to give a number. But I'd say in most cases, I don't know what percentage, but it would definitely be the majority. I was just the owner had a number, and I worked to see if I could get that number. And in most cases, I was able to achieve the number that they had in mind. In a few cases, there was some negotiation to get down to a number that made more sense for me, but it was also a big win for the seller.
Yep. Nope. That's awesome. That's exactly what I do too. Before we start wrapping up, what have I missed? What else you got going on?
I guess a little bit of a sales pitch is that with the success in building a team in Latin America, I actually partnered with with somebody that I met on Twitter, and we started a nearshore headhunting agency. It's called HireLatam.com. Nice. We've hired for a bunch of storage operators, customer service, operations, even like finance, accounting, and bookkeeping roles. So if any of the listeners are interested in exploring hiring in Latin America, reach out. I'm on Twitter as @SultanofStorage. You can search my name, Baird Kleinsmith, or Sultan of Storage, and you'll find me there. And then I think you can go to sultanofstorage.com, and there's contact information to reach me there. And if anybody wants to talk storage, hiring remote in Latin America, I encourage them to reach out. I'm an open book. I share as much as I can.
That's awesome. Well, you beat me to my last question, but I do have two more. So what's next for you?
Yeah. So I am now. I'm happy with where my storage portfolio is, and I'm going to be much more strategic in buying assets that fit within sort of a core target of Southwest Colorado, Northwest New Mexico. I'm not scattershot as much as I was before. I'm trying to concentrate a portfolio here where I live. And then I'm enjoying working on side projects. Like Hire Latam's a good example. I've got other ideas for other things that I can do. So I think storage is now kind of like this cash flowing machine, and I've got a great team that runs it. It doesn't require a lot of my time. So now I can go do other stuff. And then traveling, my wife and I are going to go ride our bikes the length of Corsica in the Mediterranean in April over about a week. And that's it. Trying to live a good life.
That's awesome. So last question, what are you better at than everybody else? What's the one thing?
Man. I don't know that I'm better than everybody else at this, but I think I have a great ability to see the potential in something that is pretty rough today. And then the second, actually probably more important piece is that I have been very action focused, and I don't overthink things. And I think I see a lot of people just get stuck in analysis paralysis, thinking they're not ready. I get a lot of people that ask, like, how do I do what you do? And my answer is start contacting owners of storage facilities. Identify a market and start calling the owners of the storage facilities. And often the answer I get is, well, but what do I say on the phone call? And but I don't know enough. Doesn't matter. You'll learn. That's the quickest way to learn, is to get or to get it into the scenario and be forced to ask questions, answer questions. You'll learn pretty quickly.
Yep. No, that's awesome. And I'm going to go on a small rant here, but I think schools teach us that, right? Schools teach us that you have to have all the information before you take the test. And that's the same thing that we see. And I never liked school. I didn't do well in school. So I'm allowed to have this opinion, but I just think schools ruin us, because it's like, here, you've got to memorize all this stuff, and then we're going to test you. Like you just said, everyone wants the answers and how they're going to talk on the phone to a seller. Just pick up the phone and call them. Have a conversation.
Yeah.
You'll figure things out.
Yeah. It's 100%. Too many people just worry about what's going to happen in reality. Like, even if, don't even think of it as a sales pitch. Just call to introduce yourself, make a connection, learn about their business. They might shut you down, but who cares? Move on to the next one.
Right. We could probably have a full episode just on that topic alone, but that's a great place to end it. Awesome stuff. Awesome story. Appreciate you coming on. Sultan of Storage. Obviously, you already said where people can find you. And again, appreciate you coming on, and we'll see you guys next time.
Thanks, John.
Thanks for following, subscribing, and listening to this episode of the Do More podcast, hosted by John Farling. To learn more or ask questions, go to l4investing.com.